Okay, so good morning, everyone. So this is case analysis part 3 of Paramount Equipment Incorporated. So in this video, we'll be discussing the identification of alternatives, evaluation of alternatives, and recommendations. Okay, so let's discuss the alternatives. For the problem statement, how should Paramount overcome its financial difficulties? We have identified 3 alternatives. Should Paramount restructure? Second, file for protection under Bankruptcy Act. Or third, consider merger and acquisition with its industry peers. For the next problem, how should Paramount proceed with the restructuring and refinancing plan? So this group proposes the following alternatives. First, divesting of assets. Second, new equity issuance. And third, debt refinancing and debt restructuring. Evaluation of In evaluating these identified alternatives, we observed the following steps. First, we studied the financial statements and metrics of Paramount, Exhibits 1 to 7 of the given case. Second, we analyzed the Paramount's financial strategy. Third, we performed financial ratio analysis through Paramount's liquidity, solvency, profitability, and market ratios. And fourth, we evaluated the company valuation and capital structure through different metrics like WACC, risk-return trade-off, enterprise value, and Altman's Z-score and other ratios. So here in the evaluation of alternatives, it is divided into 3 parts. Part 1 is on the analysis. Second is on the evaluation proper of the alternatives of problem 1. And part 3 is the evaluation of alternatives for the second problem. So for part 1, we have here the subsections of analysis. We have first, the financial statement analysis of Paramount Equipment Incorporated. Second, financial statements analysis with industry peers, T-Rex and McHale. Third, risk-return, capital structure, and WACC analysis. And fourth, Altman Z-score analysis. So in this part, when we look at Paramount Equipment financial statements, we look at the ratio analysis for short-term creditors, long-term creditors, and for common shareholders. Paramount short-term creditors like the suppliers and banks, they want to be repaid in time. So actually the focus is on the company's cash flows and on its working capital because these are the company's short-term primary sources of cash. So actually, as we can see here, at the end of 2010, the cash flow of Paramount is unhealthy, no? So the cash flow from operations, even if supplemented by the cash inflow from investing, from selling of some assets, is still not adequate to cover the cash outflow from financing. So evidently, the company needs to refinance from debt, new debt, or selling stocks as it cannot rely on its own cash flows. So we have here the operating cycle of Paramount, which has become a cash sink instead of becoming a cash pump since late of 2005 up to present, up to 2010. So though it has slightly improved in 2008. So instead of it becoming a cash pump, it has become a cash sink. There's no new cash generated. So Paramount's free cash flow is negative, suggesting that the company needed to really obtain cash from other sources. So this is actually an indicator of Paramount's poor financial performance and position. So as you can see here, we compare the net income and the cash flow. We need to look at this because sometimes the net income is actually disguising only the negative cash flow. So you can really evaluate and assess the company's operations through its cash flow statement and not on the income statement, because if the income statement will show steady increase in net income but its cash flow is declining, so that's really there's some sort of problem in that case. So when we interpret the statement of cash flows of Paramount, we need to examine the cash provided by operating activities. So Paramount's negative cash flow from operations is actually another sign of fundamental difficulties, and it has plummeted since 2008. So this figure reflects that the company has not been generating cash on a continuing basis for the past 4 years already. As you can see here, we try to compare the asset composition and the debt composition of Paramount. So actually, Paramount is employing an aggressive financing strategy, no? So actually, the hedging principle or the rule of self-liquidating debt is actually used to determine the appropriate level of working capital. So this hedging principle states that short-term financing should be appropriate for short-term investments and long-term financing for long-term investment. So as what we can see from Paramount, it has very aggressive financial strategy because it is financing its long-term investments and acquisitions with short-term debts. So actually, yung strategy ni Paramount could be fueled by its desire to secure debts with lesser cost, because as we can remember, the yield curve, if it is normal, it is upward, so interest rates actually increases upward. So short-term debts have lower interest rates and longer-term debts have more expensive interest to compensate for the increased risk in longer time of recovery for maturity. So though Paramount may see this as an edge for cheaper financing, that this financing strategy actually entails too much risk, and actually it is actually backfiring to Paramount, because it is bleeding to meet currently maturing obligations. Okay, so looking at Paramount's net working capital, so its financial storm actually started on 2006 rather, when the level of its current liabilities, here, the orange, exceeded the level of its current assets, the blue. Okay, so its net working capital has plummeted, since then, since 2006 pa downward na. Okay, this is helpful if we look also to the other four ratios like the current ratio, asset debt ratio, the accounts receivable turnover, and inventory turnover. As you can see here, Paramount's current ratio has been diving below 1.0 here, starting from 2006. So it is paying out more, than it is actually collecting. So as you can see in the quick ratio and the cash ratio, it shares the same trend. So as we can see here, Paramount really has a serious cash flow leak problem for the past years. Okay, so the company's suppliers already demand payment. So we can look here. The operating cycle is the inventory conversion period plus the average collection period, and this is the payable deferral period. So the blue actually tells us how fast cash is converted, used in inventory and accounts receivable, and then collected again back to cash. So as we can see, early pumupunta si suppliers to claim accounts payable than the ability to generate and realize cash. So this demonstrates that cash sink yung naging operating cycle ni Paramount instead of a cash pump, kasi sa isang operating cycle niya hindi siya naka-generate ng cash to pay its payable. Instead, naghahanap pa siya ng resources to pay its payable. Okay, so there's a sharp increase here in the in the accounts receivable. So actually, yung sharp increase in the Paramount's accounts receivable is actually a reason maybe for the deteriorating cash, because of its inability to collect from customers. So as we can see here, the average collection also has become longer to collect, and it has formed larger chunks of the company sales, So this means that too much company resources are already being tied to customers' hands, which are actually non-interest resources, as this will be collected only at face value. So therefore, Paramount needs to revisit its credit policy, whether it has been too lax to grant credit sales to less creditworthy clients, kahit sino-sino na lang, just to boost sales, or maybe the credit terms is unfavorably too long, no, to please or to consider customers. So it has also been took longer, no, to convert inventory as shown by the increasing inventory days. So inventory level also on a common size statement is also at a steady increase, either maybe to too much inventory level in Paramount, or obsolete inventory, or loss of market interest in Paramount's products. So on the other hand, accounts payable has been steadily declining in the common size statements, either due to stricter credit terms or restricted supply by suppliers, no? So this is also supplemented by the hastening, no, pinapabilis ni suppliers yung collection, as can be seen here, no, ni payable deferral from 86 ginawa niyang 276, no? So in sum, no, Paramount has longer days of cash flow leak, no? The longer the cash flow leak, the more resources needed, no, to be hanapan ng paraan, no, just to plug this leak. So Paramount's long-term creditors are actually concerned with the Paramount's ability to pay its loans, no, in the long run. So in the long run, interest yung concern nila, kasi kung hindi nga nababayar yung interest, how much more the principal. So we will be looking at the interest coverage ratio. So as what we can see here, it has plummeted again to less than 1, no? So the times interest earned, or the interest coverage ratio of less than 1 is actually very inadequate, because interest expense exceeded the earnings that are available to pay the interest. So we can see here the debt ratio and the equity ratio. So it comes at opposing directions, no, because ordinarily, no, stockholders would like a lot of debt, no, here, to make use of the financial leverage, no. On the other hand, since equity represents the excess, no, of total assets over total liabilities, so nagiging buffer ito of protection for the creditors. Hence, creditors would like to see less debt and more equity. So we can see here, no, company debt to equity ratio is rising, no, from 2001 up to this level, up to 5.0 debt to equity by 2010. So actually, yung normal for industry in the for debt equity is from 0, no debt, to 3.0, medyo common siya, but 5.0 of Paramount is already too high, and future long-term creditors will really charge Paramount higher interest rates to compensate for this higher risk. So ibig sabihin, more on galing yung pera from creditors, so they are bearing more risk, hence they are requiring more return. Okay, so we now go to the ratio analysis for common shareholders. So actually, common shareholders focus on net income, dividends, and stockholders' equity. So first stop, earnings per share. So earnings is the basis for dividend payments and future increases in the share value. Hence, investors would like to see what is Paramount's EPS for the past few years. So actually, it has no earnings. So since 2007, it has dived, no? So 2008, there's no earnings per share, but it's rather loss per share, no? It's still gasping, no, for air, no, up to 2010, because it is still negative. Okay, so for price earnings ratio, we can see, no, that the relationship between the shares market stock price and the stock's EPS, no? So nakikita natin dito ano yung gano'n siya ka-attractive, no, to the investors, no? So actually, its price earnings ratio plummeted since its share price is actually plummeted, no? So nagka-wrong turn talaga during 2006, 2007 downwards. Okay, so the company's price earnings ratio is very low, hence investors are really not that impressed with the Paramount's future earnings growth potential, and they see Paramount share as less attractive. So actually, here we have the dividend yield. So actually, Paramount employs a stable dividend policy, no, of $0.4 from 2008 up to 2001 up to 2008. So actually this is flat 0.4, 0.4, 0.4, 0.4. It stopped paying dividends on 2009 and 2010. During 2009, it's less than 0.4, but still it paid, no, even if they have no earnings, no, since 2008, but still they continue to outsource cash, no, just to pay 2008 and 2009 dividends. So on 2008, Paramount made the right call, no, to stop paying dividends, since actually the dividend payments for 2008 and 2009 was not actually enough, no, to retain the attractiveness in the market, no. So it's because its share price is still decreased. So this is their dividend yield, and it's not looking so good. So let's try to look at Paramount's return on assets and return on equity. So as we can see here, Paramount's ROA, no, only earned a return of actually 2 to 3% on average total assets employed from 2001 up to 2007. And it has declined, no, since then, no, to give a negative return on assets. So hence, Paramount is actually playing, no, a difficult game of having too much investments on its fixed assets, no. But those investments on fixed asset na supposedly mag-earn ng high, it is actually earning too low, no. So it is actually gaining negative returns, no. On the other hand, Paramount's return on equity is averaging 5%, no, from 2001 up to 2007, no. So it has suffered returns, no. The ROA suffered from 2008 up to 2010. Okay, so actually financial leverage results from the difference between the rate of return that the company earns from its assets and the rate of return that the company must pay its creditors, no. So we can see, no, from 2001 up to 2007 up to this point, Paramount's ROE has been higher, no, itong orange, no, as compared to the ROA, no. So it can be inferred that having debt, no, in Paramount's capital structure is actually beneficial to common stockholders because it has given a positive financial leverage, no. So as what we can see, starting 2008 up to 2010, no, Paramount's rate of return on total assets is actually less, no, less than the stockholders return, no, less than the return that the company pays its creditors. So its financial leverage is already negative kasi on this point si ROA is si ROE natin, return on equity, is ano na, mas lesser compared to the ROA. So the assets are not actually benefiting, no. The financial leverage is actually not benefiting the stockholders anymore. It is hurting actually the stockholders because leverage, though it is very good, no, kasi konti lang na capital, then malaki yung return, no, on equity, but it is a double-edged sword, no. Depende sa paggamit. If the leverage is used positively, then it benefits the stockholders because it gives higher ROE. But if leverage is being used negatively, then it is harmful, no, actually detrimental to the common shareholders because it is bleeding, no, the common shareholders. The common shareholders will be suffering already. So as what we can see here, no, the book value versus the share price, no. So Paramount stockholders have been suffering from declining book value since 2008, no. So notice, no, in this graph, no, that the Paramount's share price have been actually lower, no, than the book value starting from 2008 up to 2010. So imagine the book value, no, the share price rather of the company is much lower than the book value that it is carried, no, on the financial statement. So stockholders not just suffered from capital losses but also threatening on its declining stocks carrying values at possible liquidation if bankruptcy arises. On this part onwards, we will discuss the financial statement analysis as compared to Paramount's industry peers. We will look at debt and capital adequacy and its profitability. In terms of employing debt, Paramount has the most aggressive financing strategy. So it is the highest on short-term debts and total debts to assets. Okay, so their trend, Paramount's trend is steadily increasing since 2005 to 2010. So it's steadily increasing as compared to T-Rex and McHale. No? So Paramount is the most aggressive as compared to its peers. No, so Paramount is actually aggressively leveraged. So T-Rex, T-Rex actually employs conservative financing, no, and McHale has a moderate financing strategy. So actually, mini-meet niya, no, McHale is definitely managing, no, its debt, no, on a very low level. Okay, so among the three, Paramount's debt equity ratio is steadily increasing, no, and actually it has worsened, no, after 2008, reaching 5.0 here, no, by 2010, no. So T-Rex and McHale are actually consciously reducing their debt to equity ratio because look at Paramount, it is steadily increasing, but for T-Rex, it is actually declining and McHale declining, no? So they are consciously reducing their debt equity ratio after the 2008 financial crisis, and T-Rex and McHale both maintain their debt equity ratio at less than 2.0. Profitability-wise, McHale is the lead among the three, no? So si McHale, itong yellow, it is the lead among the three, no? In terms of operating margin and profit margin. Also, no, if we compare their financial leveraging, no, Paramount is suffering from negative financial leverage, no, starting 2007 here, no. No, so wala na, si blue is nandiyan sa taas, si red, si return on equity is plummeting. As compared to T-Rex and McHale, no, yung red na sa taas, so it means positive, no, yung leverage niya, no, their use of debt actually benefits the return on equity. So in this session onwards, no, we will be discussing the risk-return, trade-off, capital structure, and WACC analysis. So if you can see here, no, Paramount actually has the lowest returns, no, lowest returns as compared to them, and actually the highest risk, no, as compared to T-Rex and McHale, no. So if actually Paramount would go, no, into merger and acquisition to partner up or team up, no, with its peer companies, comparing, no, its risk and return to peer in the companies would be the start, no. So T-Rex actually has the highest return as compared to McHale, no, 21% to 13%, while McHale actually has the lower risk, no, 0.005, no, versus 16%, no. So how do we evaluate this situation when one company, one stock has the higher return while the other stock has the low return? Because generally investors want high returns but we want low risk, no? So how do we determine, no, kung sa perspective ni Paramount, kung sino yung mas magandang i-add niya, no? So we look at the coefficient of variation. So coefficient of variation is the best criterion as it incorporates both risk and return, no, as expressed in risk per unit, no. So actually the lower the coefficient of variation, the lower the risk. So hence the lowest, no, risk here is McHale, no, 0.04%. So now if we try to eliminate some risk, no, by joining them in a portfolio context, no, diversifying risk, no, eliminating the diversifiable risk, we will look at how they are related to each other. So let's look at Paramount and T-Rex. So actually, Paramount and T-Rex, they belong to the same industry, construction equipment industry. Yun, ito talaga yung main competitor ni Paramount, as T-Rex is also a construction equipment manufacturer. So more or less, they have the same operations, no, the same customers. So let's compare them, no. So actually, they have a positive correlation coefficient of 0.89, no. So positive, Paramount and T-Rex are positively correlated stocks, no. Their expected return moves up and down together, no, because they are in the same industry. So therefore, a portfolio consisting of these stocks is actually as risky as individual stocks, no. So kung i-join mo si Paramount and T-Rex, the same risk as if si Paramount lang yung i-hold mo or si T-Rex lang yung i-hold mo. Thus, Paramount and T-Rex might not be a good match, no. So let's look here, no, Paramount and McHale. So actually, Paramount and McHale are competitors in the food service industry. Okay, so the correlation coefficient is negative 0.23. So Paramount and McHale, no, are negatively correlated. So some risk can be diversified away by combining them. So if Paramount, no, should Paramount consider M&A, no, merger and acquisition, McHale would be a good fit, and it's also a blooming industry and there's too much opportunity there. So McHale is actually a very good candidate. So let's try to look at the capital structure of Paramount. So as you can see, its debt ratio is steadily increasing through time. So they accumulate more debts, no, than adding more equity. Okay, so it's more or less 80% at the end of 2010. So our debt to equity ratio is actually approaching 5.0. So now let's compute for the WACC. No? So the assumptions used, the estimated cost of debt is 15%. So this is actually based on the assumption that Paramount is actually the cost. This is the estimated cost of new debt. No, since Paramount is already in a poor financial performance and poor financial position, and is actually facing the threat of bankruptcy, it is quite normal to investors or creditors to charge higher interest rates because of poor performance ni Paramount, no? So the tax rate is based on financial statements. It is 35%. Estimated unlevered beta is 1.0 if assuming Paramount has no debt. Estimated risk-free rate is 3%. So gathered from the research, no, from the U.S. Treasury database. For 2010, it is averaging at 3%. And also on the same source, the estimated risk premium is at 5.6%. So we just used 6%. So using CAPM model, no, for the cost of equity, risk-free rate plus risk premium multiplied by the beta, we have 3% plus 6% times 4.1161. So we have our cost of equity of 28%. So look, if we use the WACC, no, the cost of debt multiplied by the after-tax rate multiplied by the weight of debt plus the cost of equity and the weight of equity. So we used 2010 debt to equity ratio that we presented a while ago. So the cost of debt is 15% multiplied by 65% after tax multiplied by 82.74, the debt structure, no, in their capital, plus the cost of equity, which is 28% that we derived a while ago, multiplied by its weight in the capital structure of 17.26%. So all in all, we have weighted average cost of capital of 12.89% or 12.9%. So this will be the basis in discounting any inflows, no, or for capital decision, capital structure decisions, we will be using going back to this WACC of 12.9%. Now, we will present the Altman Z-score analysis. This Altman Z-score is actually developed in 1968 by Edward Altman, no, to predict bankruptcy or financial distress of a business, no, using a blend of the traditional financial ratios and a statistical method known as multiple discriminant analysis. So actually, itong Z-score is known to be 90% accurate actually in forecasting business failure, no. In more recent years, actually, yung recent score, Z-score daw, closer to 0, actually indicates a company that is in financial trouble. No? So, Professor Altman himself noted that, no, in his 2019 study, 50 years of Altman score, no, 0, not 1.8, is the figure at which investors should worry about a company's financial strength. So, what is the formula of Altman Z-score? So, it is 1.2 times working capital divided by total assets plus 1.4. Ito mga given ito na constants. Okay? So, we plug in, no, the data. So, Paramount's financial strength actually is weakening. So, if we look here, no, it is actually weakening, no? It is almost approaching to 0. So, if there is no drastic changes, it is actually headed, no, to bankruptcy. So, we can look here, no? So, pababa ng pababa, no? Okay, so, originally, yung kay Altman is 1.8 pa daw, mag-worry na. But, on 2019, Professor Altman change, no, na mag-worry lang if it is really approaching to 0. So, this is really approaching to 0 because this is less than 1 already. So, papunta na doon, but we can see some hope here, 2009 to 2010, it is somewhat recovering, okay, but still below 1.